Welcome back to the channel. GS boring currency. Silver didn't just correct, it collapsed. 40% of its value gone in a week. This wasn't a bad trade. It was a forced liquidation, a warning shot from the market. When a market breaks this fast, it's never just about the metal, it's about what comes next. The shock event. When a bull market breaks, the collapse in silver prices did not unfold as a gradual correction. It arrived abruptly, violently, and with a speed that immediately distinguished it from ordinary volatility. After a powerful surge that had reinforced bullish confidence across commodities and alternative assets, silver lost roughly 40% of its value in a single week. For experienced market participants, this was not merely a sharp drawdown, it was a structural shock. At first glance, such price behavior is often explained away with familiar language: profit-taking, overbought conditions, or speculative excess. Yet those explanations fail to account for both the magnitude and the timing of the move. Corrections typically occur when demand weakens or supply overwhelms buyers. In this case, neither condition was clearly present. Physical demand indicators showed no sudden collapse. Industrial usage had not meaningfully deteriorated. Retail interest remained elevated. The breakdown occurred elsewhere. To understand the event, it must be framed not as a failure of silver itself, but as a failure of the market structure that determines its price. Silver is not priced primarily through the exchange of physical metal. Its global reference price is discovered through futures contracts traded on venues such as COMEX. These contracts represent claims on silver, not silver itself. In normal conditions, this system provides liquidity and efficiency. Under stress, it introduces fragility. The surge preceding the collapse created a crowded trade. As prices rose, leverage increased. Traders added futures exposure to amplify gains. Margin requirements remained manageable, while volatility stayed low, reinforcing the perception that the trend was stable. This is a recurring pattern in financial markets. Rising prices mask structural risk. Strength is mistaken for resilience. When price momentum slowed, the system's vulnerabilities surfaced. Small downward moves triggered margin pressure for leveraged participants. Margin calls are not judgments, they are mechanical processes. When volatility increases or prices move against a position, additional capital must be posted immediately. If it is not, positions are liquidated automatically. Selling begins not because conviction changes, but because capital constraints intervene. This distinction is critical. The initial wave of selling was not a collective reassessment of silver's long-term value. It was a forced response to market plumbing. As liquidations began, liquidity thinned. Buyers stepped back, uncertain whether prices reflected value or distress. Bid-ask spreads widened. Algorithms, designed to reduce exposure under rising volatility, amplified the move. Each sell order pushed prices lower, triggering additional margin calls, which generated further selling. The feedback loop accelerated. In this environment, the futures market became detached from physical reality. While contracts were aggressively sold, physical silver inventories did not flood the market. There was no equivalent surge of supply, leaving vaults or refineries. The price decline occurred almost entirely within the paper layer of the system. This divergence exposes a fundamental asymmetry. Futures markets allow for near infinite selling pressure because contracts can be created and unwound without immediate physical constraint. Physical markets, by contrast, are bounded by inventory, logistics, and production capacity. When stress originates in paper markets, prices can fall far faster than physical fundamentals would justify. The speed of the collapse is therefore not incidental. It is diagnostic. Historically, similar events have appeared at moments when leverage across the financial system becomes unstable. Sharp, waterfall-style declines often occur not at the beginning of a crisis, but at inflection points, when rising prices can no longer absorb accumulating stress. The surge preceding the collapse encouraged exposure precisely when underlying liquidity conditions were tightening. Another warning signal lies in the lack of orderly price discovery. Healthy corrections unfold with volume on both sides of the market. Buyers emerge as prices fall. In this episode, price gaps appeared, indicating that bids vanished rather than competed. That absence of demand is not a statement about silver's desirability. It is evidence of participants stepping away from a market they could not reliably price. For decision makers, this distinction matters. Volatility driven by sentiment can be managed. Volatility driven by structural mechanics is more dangerous. It suggests that prices are being set not by informed judgment, but by constraint-driven liquidation. The central question is therefore not why silver fell, but what the fall reveals. A 40% decline in a week signals that leverage had reached levels incompatible with available liquidity. It signals that pricing power resided with forced sellers, not rational allocators. And it signals that the apparent strength of the preceding surge concealed growing instability. This was not simply a bull market that corrected. It was a market that briefly lost its ability to function smoothly under stress. In the next stage of analysis, the focus shifts beneath the headline price action to the internal mechanics that transform stress into collapse, leverage, margin enforcement, and liquidity withdrawal. Because without understanding the plumbing, the shock itself cannot be properly interpreted or anticipated again. Ever wonder what really makes the financial markets tick, or sometimes what makes them explode? It's not always about picking the right stock. Often it's about something much deeper, something we call market plumbing. Today, we're diving into the hidden gears of the market: leverage, liquidity, and the dreaded forced liquidation. Stick around, because understanding this will change how you see every market crash. So let's start with leverage. Imagine you want to buy a $1 million house, but you only have $100,000. You borrow the other $900,000 from a bank. That's leverage. In finance, it's the same idea. Traders use borrowed capital to increase their potential returns. If your $1 million investment goes up by 10%, you've made $100,000 on your initial $100,000. That's a 100% return. Sounds amazing, right? But here's the catch. Leverage is a double-edged sword. If that investment drops by just 10%, your initial $100,000 is completely wiped out. The higher the leverage, the bigger the potential gains, but also the bigger the potential for catastrophic losses. Now, let's bring in the second key component: liquidity. Think of liquidity as how easily you can buy or sell an asset without drastically affecting its price. Cash is the most liquid asset. Real estate? Not so much. In financial markets, stocks for big companies like Apple are usually very liquid. There are always buyers and sellers. But for smaller, less-known assets, liquidity can be thin. This means if you need to sell a large amount quickly, you might have to accept a much lower price because there just aren't enough buyers at the current price level. Low liquidity is like trying to exit a crowded theater through a single small door. It can get messy and slow. All right, now for the grand finale where it all comes together: forced liquidation. This is the drama, the main event of a market crash. Let's go back to our leveraged trader. Say their investment starts to drop. The broker who lent them the money gets nervous. They have rules to protect themselves. If the value of the investment drops to a certain point, the broker issues a margin call. This means the trader has to add more of their own money to cover the potential losses. But what if they can't? What if they have no more cash? This is where forced liquidation happens. The broker takes control and sells the assets, often at any price they can get, just to get their loan back. Now imagine this happening not just to one trader, but to thousands of traders all at once. A small price drop triggers a few margin calls. Those traders are forced to sell. Their selling pushes the price down even further. This lower price then triggers more margin calls for other leveraged traders, who are then also forced to sell. This creates a terrifying domino effect, a liquidation cascade. Prices plummet, not because the underlying asset has suddenly become worthless, but because a wave of forced selling is flooding the market. And remember liquidity? If the market is illiquid, these forced sales have an even bigger impact, pushing prices down faster and further. This is the engine of a flash crash. It's pure mechanics, a plumbing problem that spirals out of control. So the next time you see the market taking a nosedive, don't just think about fear and panic. Think about the plumbing. Think about highly leveraged positions being unwound, creating a tidal wave of forced selling into a market that might not have the liquidity to absorb it. Understanding this mechanism is crucial. It helps you see beyond the headlines and appreciate the powerful, often invisible forces that shape our financial world. It's a reminder that managing risk isn't just a suggestion. It's the key to survival. Why did the silver market collapse? It wasn't an isolated event. To understand what happened, we need to look at the bigger picture, the macroeconomic context, because leverage only becomes a problem when the financial environment turns hostile. At the heart of it all was a major shift in monetary conditions. Think about it. Silver, like gold, doesn't pay you interest. It competes with assets that do, like bonds. When real interest rates are low or even negative, holding precious metals is a no-brainer. The opportunity cost is tiny, but when real rates start to climb, everything changes. Capital naturally flows back to assets that offer a yield, safety, or both. This shift doesn't have to be a sudden explosion. It just needs to be persistent. In the time leading up to the collapse, the market's expectations about monetary policy began to solidify. Everyone started pricing in a longer period of tight, restrictive conditions. The message from the Federal Reserve was clear, even without more rate hikes. Don't expect easy money to bail out volatile assets. This signaling, this change in expectation, was more powerful than any single policy decision. The Fed's influence was indirect, but absolutely decisive. Central banks shape how we all behave with our money, not just through their actions, but by managing our expectations. By sticking to a tough stance on inflation, they effectively increased the cost of borrowing money across the entire system. Funding got more expensive, and balance sheets had less room to breathe. The pressure on anyone using leverage intensified. As interest rates rose faster than inflation expectations, real yields went up. For traders using leverage, this was a double whammy. First, their financing costs shot up. Second, the US dollar got stronger. Both of these were bad news for silver. A stronger dollar makes dollar-priced commodities like silver more expensive for buyers using other currencies. But more importantly, a strong dollar acts like a global vacuum, sucking up liquidity. It's a sign of capital flying to safety and a general aversion to risk, exactly the kind of environment where speculative bets are closed out, not opened. Silver is in a unique spot. It's both an industrial metal and a hedge against monetary debasement. When money is easy, this dual role is fantastic for demand. But when policy tightens, it becomes a liability. Industrial demand doesn't just disappear, but it can't prop up the price when a flood of financial selling hits. At the same time, demand for silver as a monetary asset weakens because real yields are rising. So during these major policy shifts, silver loses support from both sides at once. This makes it incredibly vulnerable. Unlike gold, which is mainly seen as a reserve asset, silver's price is much more sensitive to changes in economic growth expectations and financial conditions. The timing of the collapse tells a story too. It didn't happen right after some big data release or a geopolitical shock. It happened as the market was slowly, painfully adjusting to the new reality of persistent monetary tightening. The fact that there wasn't one single obvious trigger is telling. It shows the system was already under immense strain. The final straw didn't matter because the camel's back was already breaking. As liquidity dried up, something else happened. Everything started moving together. Stocks, commodities, alternative assets. They all started reacting to the same thing, the cost and availability of capital. In this kind of environment, diversification doesn't help much. Assets fall in unison, not because their fundamentals are connected, but because their funding sources are. For silver, this meant that futures positions, often funded through the same channels as other speculative trades, were being unwound right alongside completely unrelated assets. The selling was indiscriminate. The market wasn't just repricing silver, it was repricing risk itself. This macro pressure also affected the big institutions. Banks and brokers, facing their own tighter risk limits and capital requirements, became less willing to step in and absorb the volatility. This drained liquidity from the market right when it was needed most, putting even more stress on the system's plumbing. Now, none of this means policymakers intended to crash the silver market. Their job is to manage inflation and financial stability for the whole system. What happens to one specific asset is a secondary consequence. When policy tightens, the most leveraged trades are always the first to break. So the silver collapse was a signal. It was a canary in the coal mine. It showed us how macro tightening ripples through the most sensitive parts of the market long before it shows up in slower moving economic data like employment. Commodities, especially those heavily traded with leverage, often react first. Sharp moves in silver aren't just about metal. They are a reflection of deep shifts in financial conditions. When a market like this collapses without a corresponding drop in physical demand, it's a clear sign that capital is being pulled out. This is why events like this deserve our attention, far beyond the world of commodities. They reveal stress in the financial system's connective tissue, the funding markets, the leverage channels, and the overall appetite for risk. The real question isn't just whether silver will recover. It's about what this collapse signals for all of us, investors, entrepreneurs, and businesses, as we navigate an increasingly challenging financial landscape. Have you been watching the silver market? You might have seen the price collapse and then thought, well, it'll probably bounce back. And you might be right. But the real story isn't about whether silver recovers. It's about what that sudden, brutal collapse tells us about the entire financial system we're operating in. Sharp, rapid declines like this are rarely just isolated events. They're signals, like a tremor before an earthquake, warning us that stress in the system has reached a breaking point. What the silver collapse really exposed is how fragile our markets have become. Price discovery, which should be based on real value, is now dominated by leverage, by borrowed money. Think about it this way. When markets are healthy, prices move because people's ideas about a company or commodity's future change. But when markets are strained, prices move because the money tap gets turned off. That's a huge difference, and it's a difference we saw play out with silver. A lot of the buying in the run-up wasn't from committed long-term holders. It was from traders using easy financing and betting on low volatility. When that financing got just a little bit tighter, they didn't gradually sell off. They vanished. They were forced to liquidate, and the market didn't bend. It broke. This is a critical lesson for any decision maker. We have systems that look incredibly liquid and stable right up until the moment they're tested. Then, all of a sudden, that liquidity disappears. The silver market was just put through that stress test, and it failed decisively. What's even more alarming is the speed at which confidence can just evaporate. The huge surge in price before the fall wasn't a sign of strength. It was a symptom of the problem. Rising prices encouraged more and more leverage, which made the market more and more fragile. That very strength became the precursor to its own breakdown. And this isn't just about silver. This dynamic is everywhere. The stock market, credit markets, even private capital. They all increasingly rely on the same things: cheap funding and rapid repricing. When times are good, this amplifies growth and makes everyone feel like a genius. But when conditions tighten, it amplifies the crash on the way down. So, the silver collapse is like a miniature model of a much bigger risk. It shows us how quickly an orderly market can spiral into chaos once leverage hits its limit. And there's never a warning bell. The shift happens in an instant. For any business owner or entrepreneur, the takeaway isn't about trading commodities. It's about understanding the environment you're in. When financial conditions tighten, getting a loan becomes harder. Terms change overnight. Hedging strategies you thought were safe might fail you when you need them most. Relying on past performance becomes a fool's game. Don't be fooled by a potential price recovery either. After a forced fire sale, prices often rebound simply because the forced sellers are gone. People misinterpret this as a sign that everything is fine, that it was just an overreaction. But the structural damage can still be lurking right below the surface. The market might look calm, but the foundations are weaker. This collapse also shines a light on the unfair nature of modern markets. Gains are made slowly, step by step. But losses? They happen all at once. Margin calls, sudden credit withdrawal, and everyone rushing for the exit at the same time ensure that the pain is concentrated and severe. The system favors those with cash on the sidelines and punishes anyone relying on leverage. For investors, this highlights the importance of resilience over pure optimization. The strategy that gives you the highest returns in a bull market is often the one that gets wiped out when stress hits. A more conservative strategy that prioritizes flexibility might not look as exciting, but it's the one that survives the storm. Perhaps the most important signal here is the timing. Historically, stress first shows up in the corners of the market where leverage is highest and liquidity is taken for granted. Silver checked both of those boxes. These small fractures are often the first signs of a much broader adjustment to come. They don't predict the exact future, but they tell us the direction of the wind, towards tighter money, less risk-taking, and a much more selective market. So we shouldn't see this as a weird one-off event. We should see it as a clear warning. It suggests our financial system is operating much closer to its limits than the headlines might tell you. It suggests that the next wave of volatility won't be some external shock, but an internal release of pressure that's been building for a long time. The right response isn't to panic, it's to recalibrate. It's time to ask the hard questions. Where's the leverage in your business or your portfolio? How secure is your access to funding? What core assumptions are you making that depend on everything staying stable? Markets rarely send a clear memo that the game has changed. They drop hints. They crack at the edges. They reveal weaknesses in places you weren't even looking. The silver collapse was one of those hints. It revealed a system that is far less tolerant of risk and far less capable of absorbing shocks than we thought. For anyone paying attention, that signal is worth far more than the price of silver itself. Thanks for watching. Think about it. For over a decade, central banks like the Federal Reserve have kept interest rates at historic lows. This made borrowing incredibly cheap. At the same time, they were pumping money into the economy through quantitative easing, buying up bonds and other assets. This flood of easy money encouraged everyone, from big corporations to individuals, to take on more debt and make riskier investments. It created a system built on leverage, making it much more fragile and sensitive to any shocks. So when a crisis hits, the whole structure is at risk of a domino effect. So how can you build resilience in this environment? For business owners, it's about being proactive. Think about securing longer-term credit lines now, while you still can, to lock in rates. It's also crucial to diversify your supply chains. Don't rely on a single supplier or a single country. That's a recipe for disaster. For investors, it's time to play defense. Holding a bit more cash than usual gives you the flexibility to seize opportunities when prices drop. And look into value investing, buying solid companies that are undervalued by the market, not just chasing high-flying growth stocks. You can also hedge your portfolio with assets that tend to move in the opposite direction of the stock market. Besides commodities, there are other warning signals to watch. Keep a close eye on the corporate bond market, especially high yield or junk bonds. If we see a spike in defaults there, it's a major red flag for the broader economy. Also, monitor housing market data. A sharp downturn in housing can have ripple effects everywhere. Finally, pay attention to the US dollar index. A rapidly strengthening dollar can cause a lot of stress in global markets, especially for emerging economies. Thanks for watching. If you found this analysis valuable, please subscribe to the channel for more insights.